What if I told you blue chip index funds and auto-enrollment comfort songs are just decoys? This summer's real drama lurks in 2 dusty footnotes of an executive order, and it's about to reach inside your 401k. Before we dig, hit pause for a coffee recharge. Let that aroma steep, because the numbers ahead aren't decaf. Rewind to July 18th, 2025, when the Labor Department slipped a 9-word loophole into an otherwise sleepy rule. On July 18, 2025, the Trump administration's Labor Department finalized a rule clarifying that private equity exposure up to 15% is fair game inside professionally managed 401k funds. Translation: your future paychecks can now buy leveraged buyouts, venture deals, infrastructure concessions, assets once locked behind velvet ropes. Wall Street cheered. Blackstone, KKR, Apollo all jumped approximately 4% on the headline. Why? The 401k pool holds $12.3 trillion. A modest 10% sleeve equals $1.2 trillion of fresh, dry powder, enough to fund every U.S. buyout twice over. Here's the part that should jolt any coffee-fueled saver. Upright. Those 9 words aim straight at your 401k. That sounds like democratization, right? Ordinary savers meet extraordinary deals. But the same document that unlocks opportunity also smuggles in 3 booby traps: illiquidity, high fees, and fiduciary crossfire. Miss those footnotes, and your retirement upgrade morphs into a fee farm. Liquidity, supposedly the oxygen of a 401k, turns out to be more illusions than safety net. 401ks need near instant liquidity. Paycheck drips in, hardship cash flows out, rollovers trigger without warning, while private equity is a decade-long vault that reports only every quarter. Still, the rule makers swear they can splice hummingbird wings onto a tortoise by a 5% cash buffer inside the target date fund, bank credit lines to honor redemptions, and fair value marks using public market proxies. Imagine rotating a cargo vessel in a koi basin. Doable, but the wave drenches the garden. If markets tank and investors rush to sell, liquid assets vanish first. The illiquid slice clings like gum to a sneaker, swelling to a quarter of what remains. Cost, not market chaos, drives the undertow. Set a 0.04% index trickle beside a 1% plus buyout siphon and watch growth shrivel. A basic broad market index fund runs at 0.04% a year. A standard buyout vehicle, 2% in yearly charges and 20% of gains. Even if on-the-job share classes trim that to 1 and 10, the drag stays severe. Over 4 decades of saving, each extra 1% in annual fees shaves roughly 19% off the final nest egg. Rough numbers on a scratch sheet: contribute $10,000 a year for 40 years, earning 7% net instead of 6%. Stash A lands near $2.1 million. Stash B levels off at $1.6 million. That's a $500,000 cost for access. Quarterly marks blow a soothing mist over real risk, delaying the hit but never dodging it. Buyout fund marks run behind listed markets. If a broad index slides 20%, your statement may still show the slow-moving sleeve, humming at plus 1%, until auditors mark it down a year later. The line looks tranquil. Risk still bites. Behavioral researchers call that false calm bias. Investors swing for the fences because the chart seems smooth. Enjoying this contrarian deep dive? Hit follow and ring the bell so Marathon Macro guards your coffee and your nest egg one stride ahead of the herd. Now back to the numbers. Fund stewards now tread a live minefield. One careless forecast and class action letters swarm. ERISA demands that fund stewards act with skill, care, and diligence. One ragged cost schedule or optimistic forecast, and class action sharks circle. Remember those runaway fee lawsuits over mutual funds? Same script, bigger stakes. Early movers, Lockheed Martin, Intel have already tucked a 7-point buyout sleeve into their target date menus. Litigation firms are gathering articles for evidence folders right now. Channel $1 trillion into unlisted assets. And watch valuations float higher while new issue lines dry up. When 401k dollars rush into these unlisted deals, ticker tags balloon and tomorrow's gains shrink. Warning signs are here. Idle cash and buyout funds hit $3.8 trillion in 2024, and median valuation ratios stretch to 12 times EBITDA, up from 8 times 10 years ago. Add another trillion and the so-called illiquidity markup may vanish mid-flight. Listed exchanges catch stray fire. Young firms linger off-market. Indexes age, and small investors outside these workplace accounts cling to yesterday's champions, while tomorrow's Teslas hide behind non-disclosure walls. History keeps scribbling warnings in red ink. 1981 gold IRAs, 1998 LTCM, 2014 CalPERS hedge fund detox. 1981, IRAs let investors hold gold coins. Levered Krugerrand schemes detonated nest eggs. 1998, long-term capital management cratered. Pensions with market-neutral sleeves booked losses nobody understood. 2014, CalPERS axed its $4 billion hedge fund program. Too costly, too complex, no alpha. They kept PE but negotiated medieval-level fee cuts and built a 30-person policing squad. Complexity without scale kills. Behavioral quirk incoming. Delayed pain feels like victory, so savers overcommit right before the markdown hits. Picture 2028. Headlines: Private equity bubble bursts. Your 2045 target date fund slips only 8% while the S&P sinks 15%. Feels like victory. Until next April, when the PE sleeve finally journals a negative 12% markdown. Pain delayed breeds false bravado. Participants overcontribute to the safer fund just before valuations catch up. Sure, Australia and the Netherlands make it look easy, but they wield $150 billion mega funds and in-house forensic teams. Australian super funds run 20% illiquids, but a single default fund can top $150 billion with in-house quants and lawyers. Dutch pensions negotiate fees to 0.7% all in and run their own diligence desks. Average US 401k, 330 participants. A committee that meets quarterly over turkey wraps. 0 analysts. Scale matters. Governance matters more. If you're staying in the game, keep these 6 rules taped to your laptop lid. Cap allocation, 5 to 10% tops. Spice, not entree. Demand net of fee targets, greater than or equal to 300 basis points over public benchmarks or WACC. Vintage diversification, auto-commit yearly to smooth boom bust. Secondary market valve, right to sell stakes at less than or equal to 10% discount before year 5. Independent pricing, quarterly marks by a third-party appraiser, not the GP's cousin. Transparent cost sheet, 1 page, management, carry, monitoring, transaction, fund-of-fund spread. If you need a pipe and magnifier, decline. And because history never stops remixing its old hits, consider the rhymes. 1933. Gold grab, Roosevelt's executive order. 6,102 confiscated citizens' gold. An instant black market bloomed, and the dollar lost 41% of its gold value after the official devaluation. 1971, Wage price freeze. Nixon's 90-day cap looked like a quick fix. By day 91, butcher shops were empty, lumber yards barren, and inflation kept marching. 2022. UK LDI crisis. Pension funds stuffed with low-risk, liability-driven leverage melted when gilt yields spiked. The Bank of England had 48 hours to stem a fire sale threatening retiree savings. Lockheed Martin slid a 7% co-investment sleeve into its 2050 fund. Year 1, statements show plus 5% versus, plus 3 for the S&P, easy to love. Yet capital calls averaged 1.6% of NAV each quarter. Missed payroll timing and the trust tapped its credit line, burning 250 basis points in interest, an invisible drag. The real GPA arrives in year 7 when those co-invests must exit a market crowded with other DC cash. Main Street meets Wall Street. PE funds acquire hospitals, newspapers, discount retailers. When layoffs hit for efficiency, the same community's retirement accounts absorb the markdown. Participants become both investors and stakeholders, often without seeing the conflict. Transparency isn't virtue signaling, it's self-defense, done right. A disciplined 7% sleeve lifts net returns 40 to 60 basis points a year. Over 40 years, that compounds to 11 to 15% more money, maybe retiring at 62 instead of 65. Done sloppy. Fees outrun alpha, liquidity crunch. Bites during a slump, and lawsuits claw back gains. Retirement shortfalls widen. Trust in the system bleeds. And if you're after straight up, no fluff breakdowns, hit subscribe and ring the bell. Because when the rules shift, the real gains go to those paying attention. Remember, context beats clickbait every time. History rhymes. Power rebrands. Stay inquisitive.